Hello, friends. Banks are quietly flagging and restricting certain cash patterns, and the people getting caught most often are over 60. If you are 60 or older and you use your bank for cash deposits, withdrawals, family gifts, or contractor payments, there are 6 reporting and monitoring triggers that can flag, restrict, or close your account. The penalty behind just one of them can reach $250,000. One report is filed automatically the moment you cross the line. Another is filed in secret, and the bank is legally prohibited from telling you it exists. Most people do not learn about any of this until the account is already frozen. Today I am walking you through all 6 and giving you the exact steps to protect your access before any of it becomes a problem. Hello, friends. Here's what the hook did not tell you. Large cash is not illegal. There is no law that says you cannot walk into your bank and deposit $15,000 or withdraw $20,000. That is your money. The problem is not the amount. The problem is the reporting and monitoring framework wrapped around it, and most people do not know the framework exists until their account is frozen or closed. Today I am walking you through 6 bank reporting and monitoring triggers that can flag, restrict, or shut down your account. Grab a pen. At least one of these applies to you if you use cash for home repairs, vehicle sales, gifts to family, contractor payments, or moving money between your own accounts. And let me say this cleanly right now. This is not an age-only law. These rules hit everyone who uses cash. What changes after 60 is that banks are also trained to watch for elder financial exploitation patterns. So the rules are broad, but the scrutiny on older account holders is sharper. That distinction matters for everything that follows. These rules change, thresholds shift, filing requirements get rewritten, and your bank is not going to call you with a briefing. I track the filings, the thresholds, the deadlines, and the complaint paths, so you can act before access to your money is interrupted. That is what this channel does. Subscribe now and let's get into it. Now, 2 kinds of viewers are watching this. The first is the comfortable retiree. Paid off home, maybe a rental property or a small LLC, solid savings. You assume these rules are for shady money and they do not touch you. You are wrong about at least one item in this video, and it is not the one you think. The second is the fixed income retiree. You are careful with every dollar. You assume banks only scrutinize wealthy people moving large sums. You are also wrong about at least one of these, and the one that will surprise you is a report you will never be told about. On every single item, I will tell you exactly which group it helps most. And stay with me to the end, because the last one is the step almost nobody takes after a bank closes an account, and it is the one that puts the issue in front of the regulator instead of the branch manager. Let's start. Number 1. The $10,000 cash report you cannot opt out of. Here is the misconception. Most people believe that if the money is legal and it belongs to them, the bank does not report it. That is not how it works. When cash transactions by or on behalf of one person go over $10,000 in a single business day, the bank files what is called a currency transaction report, or CTR. In plain English, it is a mandatory federal report. The bank does not ask your permission. The bank does not have the option to skip it. Currency here means cash or coin, not a check, not a wire, not an electronic transfer, cash. And here is the part people miss. The bank aggregates. You deposit $6,000 in the morning and $4,500 in the afternoon, and the bank still sees $10,500. That is over the threshold. The report gets filed. The bank is also going to ask for your social security number and a government-issued ID as part of that filing, using FinCEN CTR Form 112. They have 15 days to file it, and they keep a copy for 5 years. This helps both groups. If you are on fixed income and you sell a car for cash, this hits you. If you are comfortable and you keep large amounts of cash at home and deposit periodically, this hits you too. The system does not care about your tax bracket. It cares about cash over $10,000 in one business day. Here is your action step. Before a legitimate big cash transaction, tell the bank plainly. Say these words. I understand a CTR may be filed. I am not trying to avoid it. This cash came from a legitimate source, and I brought the paperwork with me. Bring the bill of sale, the invoice, the receipt. Make the deposit clean and documented. That is number 1. That first one is the rule everybody half knows. The next one is where people talk themselves into making it worse. Number 2. The under $10,000 trap called structuring. The misconception here is dangerous. Some people hear about the $10,000 threshold and think they are helping themselves by keeping each deposit just under the line. $9,900 here, $9,900 there. No report, no hassle. That thinking can put you in federal criminal territory. Structuring means breaking cash transactions into smaller pieces for the purpose of evading the CTR reporting requirement. It can happen across days. It can happen across branches. It can happen across different accounts or even different banks. And it does not require $10,000 in a single visit. $9,900 three times is $29,700 in a pattern that can look a lot worse than one clean documented deposit. The penalty for structuring can reach up to $250,000 in fines and up to 5 years of imprisonment. And if the structuring involves more than $100,000 in a 12-month period or is tied to another federal violation, that penalty can be doubled. Now, and this is critical, not every repeated deposit just under $10,000 is automatically structuring. The Federal Examiner's Manual says 2 slightly under threshold deposits days apart should not automatically be assumed to be structuring. Context and intent matter. The question is whether the purpose was to evade the reporting requirement. But here is the thing. You do not get to make that determination. The bank's compliance team does. And a pattern of deposits at $9,900 gives that team every reason to look harder. A man I heard from after one of my banking videos had this exact problem. Leonard, 68, retired machinist, living outside Muncie, Indiana. He sold a pickup truck for $15,000 in cash. He did not want what he called government paperwork, so he went to the bank, deposited $7,500, and came back later with the other $7,500. He thought he was being smart. What he was doing was creating a pattern that looks like structuring. The fix was simple. Stop splitting the transaction. Bring the bill of sale. Tell the teller plainly that he was not trying to avoid a CTR. Keep the full $15,000 deposit clean and documented, all at once. That $15,000 stays traceable and explainable instead of turning into a compliance headache. This helps both groups, but it leans toward fixed income. This is the viewer who thinks splitting cash is the harmless way to avoid hassle. It is not harmless. It is where hassle becomes a federal statute. Your action step. Never split a legitimate transaction just to stay under $10,000. Walk up to the branch and say, "I was told there may be a reporting threshold. I do not want to break this up. What documentation do you want from me so I can handle it correctly?" One conversation. That is it. That is number 2. And that brings us to the report that matters more, because this one you are never told about. Number 3. The secret report you are never told about. The misconception is simple. If I stay below $10,000, there is no report. That is wrong. There is a second report, and this one is confidential. It is called a Suspicious Activity Report, or SAR. In plain English, when a bank sees activity that looks suspicious enough, it files a separate federal report, and the customer is never told. The bank is legally prohibited from disclosing that a SAR has been filed. For banks, required SAR territory begins when a transaction involves or aggregates to at least $5,000, and the activity appears illegal, designed to evade reporting rules, or has no apparent lawful purpose. A transaction for SAR purposes includes a deposit, a withdrawal, a transfer between accounts, an exchange, a payment, or any other transfer. And banks can also file voluntarily on suspicious activity below $5,000. 2 suspicious moves of $2,600 can already put you over $5,000. The bank has 30 calendar days to file the SAR after detecting suspicious facts. If no suspect is identified, they can take an additional 30 days, but never beyond 60 calendar days. Supporting documentation is kept for 5 years, and at no point in that process does anyone call you. The system does not pause because your transfer had a legitimate purpose. It files first and sorts later. That is the design. This helps both groups equally. The comfortable retiree learns that non-cash transfers can still be reviewed. The fixed income retiree learns that the scariest report in the system is the one they will never hear about. Your action step. When a bank starts asking unusual questions about transfers, withdrawals, or deposits, answer with a short, documented explanation. Not nervous improvising, not defensive silence. Say, "This transfer was for roof repair," or "family gift," or "moving funds between my accounts. Here is the invoice, bill of sale, or written explanation that matches the date and amount." Match paper to the transaction, match the dates, and keep your answer brief. The 30 and 60-day SAR timing is bank side only. You have no filing deadline. But the sooner your activity has a documented explanation attached to it, the better your position. That is number 3. Up to here, it sounds like a big cash story. For older account holders, the real monitoring goes wider than that. Number 4. Why seniors can draw extra scrutiny even when the money is theirs. I need you to hear this one carefully because this is where the video changes direction. Everything I have covered so far has a hard dollar line. $10,000 for a CTR, $5,000 for a required SAR, a structuring pattern built around those numbers. But for customers 60 or older, the monitoring system widens beyond specific dollar thresholds. FinCEN issued an advisory on elder financial exploitation. In that advisory, older adult means 60 or older, and the red flags banks are told to watch for are not just about large cash. They include sudden, significant withdrawals, uncharacteristic transfers, wire attempts that do not match the customer's history, signs of caregiver influence, unusual movement of funds that the customer may or may not have initiated themselves. The misconception is that these are money laundering rules aimed at criminal operations, not ordinary older customers. But the numbers say otherwise. FinCEN's 2024 trend analysis found that financial institutions filed 155,415 elder exploitation-related reports, tied to more than $27 billion in reported suspicious activity in just 1 year, from June 2022 to June 2023. That is not a side project. That is a national compliance priority. So when you, at 68 or 72, withdraw $14,000 in cash for a roof repair, and then send a family wire transfer a few days later, the money might be entirely yours and entirely legitimate. But the pattern, sudden, significant, uncharacteristic for your account, can match the same red flags the bank is trained to escalate. Consider a retiree named Evelyn. She is 74, a retired school secretary, living outside Tulsa, Oklahoma. After storm damage, she withdrew $14,000 in cash for a roofing job and then sent a family transfer a few days later. The money was hers. The purpose was legitimate. But the pattern was sudden and unusual for her account history. Her fix was paperwork. She brought the contractor invoice. She brought proof of the storm repair job. She kept the withdrawal record. She wrote a simple explanation of the family transfer. When the bank had questions, the questions had answers, tied to specific dates and specific amounts. That is the difference. Not whether the money is yours, whether the explanation exists before the compliance team starts looking. Home repair cash, family gifts, moving money between savings accounts, these are not official FinCEN banned transactions. But when they are sudden, significant, or uncharacteristic for an older customer, they can resemble the advisory's red flags. And resembling the red flags is enough to trigger a review. This hits fixed income viewers hardest. Scam pressure, caregiver influence, and urgent cash movement land disproportionately on this group, but it applies to anyone over 60 whose account suddenly does something it has never done before. Your action step. For large or unusual activity on your account, keep the paper trail in the same week. Invoice, contract, gift note, bill of sale, estate paperwork, or power of attorney documents if someone is helping you. If the bank contacts you, say, "This was unusual for me, but it was legitimate. Here are the records that explain the source and purpose." Match the paper to the transaction. Keep the timeline tight. That is number 4. Now let me show you the part the comfortable retiree usually gets wrong. The ownership paperwork story they think disappeared. Number 5. The beneficial ownership confusion most viewers are hearing wrong. If you have an LLC, a small corporation, a rental property entity, or any legal structure tied to a bank account, this one is yours. And the misconception is everywhere right now. A lot of viewers heard that beneficial ownership reporting changed, and they assumed that meant banks stopped asking ownership questions. That is not what happened. 2 separate systems are involved, and most people are mixing them up. The first system is FinCEN's BOI reporting under the Corporate Transparency Act. That is the one that changed. As of the March 26, 2025 interim final rule, all entities created in the United States and their beneficial owners are exempt from BOI reporting to FinCEN. FinCEN says it will not enforce BOI penalties or fines against U.S. citizens or domestic reporting companies under this interim rule. If you formed your LLC in the United States, you do not file BOI with FinCEN right now. But here's what most people miss. The second system did not go away. Banks still collect beneficial ownership information for legal entity accounts under their own customer due diligence rules called CDD. That is a separate requirement. And under CDD, the bank can require identifying information on up to 4 ownership prong individuals plus 1 control individual. The ownership threshold is 25%. So a small LLC with 4 equal owners can still mean 5 different people the bank wants identified, 4 owners plus 1 control person, even though the company no longer files BOI with FinCEN. The BOI headline did not erase the bank's own questions. It changed one filing. It did not change the other. This is the surprise item for the comfortable group. Here is the part where the comfortable retiree usually tunes out, and you should not. If you have a paid-off rental, a side business, or an LLC holding property, and you assumed the BOI news meant your bank would stop asking about ownership, you assumed wrong. The bank-side collection is still in force. For qualifying foreign entities only, newly registering foreign reporting companies have 30 calendar days after notice their registration is effective to file an initial BOI report with FinCEN. That deadline does not apply to most viewers, but if it applies to you, it is a hard 30 days. Your action step. If the bank sends you a letter or asks about ownership on your entity account, do not ignore it, and do not assume the BOI headlines answered the question. Ask this: are you asking me about FinCEN BOI reporting, or are you asking for the bank's own beneficial owner information for this account? That one question separates the two systems and tells you which paperwork you actually need to provide. If you need to check your BOI status, go to fincen.gov/BOI. This item is the most year-sensitive piece in the entire video. The rules on BOI changed in 2025, and FinCEN's own page says older conflicting guidance should be disregarded. If you are watching this video more than a few months after it was posted, verify the current rules at fincen.gov/BOI before acting. That is number 5. And if any of this ends with your account restricted or closed, the next move is not guessing. It is knowing exactly where to file. Number 6. If the bank freezes or closes the account. This is the one I teased at the beginning, and it is the one almost nobody takes after a closure. So let me walk it through carefully. Banks may be allowed to freeze or close an account under some circumstances, and in some cases they can do it without giving you prior notice. That means the urgency here is not a filing deadline or a threshold number. It is access to your entire account balance and how fast you move the issue to the right place. The misconception is that once the bank shuts the account, there is nothing you can do but argue with the branch manager. That is not true. There is a regulator path. If your bank is a national bank or a federal savings association, the regulator is the Office of the Comptroller of the Currency, the OCC. The OCC has a customer assistance group, and they take complaints. Here is the process. First, try the bank directly. Ask for a written explanation. If that does not resolve it, go to helpwithmybank.gov/who-regulates-my-bank and confirm that the OCC is the right regulator for your institution. If it is, file your complaint at helpwithmybank.gov/file-a-complaint. You can also call the OCC Customer Assistance Group at 1-800-613-6743. Monday through Friday, 7 a.m. to 7 p.m. Central Time. Or mail the complaint to OCC Customer Assistance Group, P.O. Box 53570, Houston TX 77052. Fax is 171-333-64301. Once the OCC receives a completed complaint form, it says it will send a written acknowledgement within 5 business days. After that, there is a written response, an appeal process, and a second-tier appeal to the OCC Ombudsman, whose decision is final. Now, 2 honest hedges. The OCC can only help if the bank is OCC regulated. Not every bank is. That is why you check the regulator lookup page first. And the OCC says plainly that it cannot act as a court, cannot give legal advice, cannot advocate for either party, and cannot seek monetary compensation on your behalf. This is not a magic fix, but it puts your complaint in front of the federal regulator instead of a branch employee who may not have the authority to reverse the decision. At that point, the number that matters is not a threshold. It is your full account balance and how fast you move the issue to the right regulator. Use these exact words with the bank before you file. I believe my checking or savings account was frozen or closed without an adequate explanation. I need the bank's legal name, the date of the decision, where my remaining balance is being sent, and the section of the deposit agreement you are relying on. Write that down. That language asks for the 4 things you need before you file with anyone. This helps both groups. Every viewer needs the complaint path if a bank acts first and explains later. That is number 6. So here is the full picture. The $10,000 cash report you cannot opt out of, filed automatically on cash over the threshold in 1 business day. Your move is to bring the paperwork and state the source. The under $10,000 pattern that can become structuring, a federal crime carrying up to $250,000 in fines. Your move is to never split a legitimate transaction. The $5,000 suspicious activity line that can trigger a secret report you are never told about. Your move is a short, documented explanation tied to dates and amounts. The older adult red flags that widen scrutiny beyond any single dollar threshold, with 155,415 exploitation-related reports filed in 1 year alone. Your move is a same-week paper trail. The beneficial ownership rule most viewers are hearing wrong, where a BOI headline did not erase the bank's own questions. Your move is 1 sentence that separates the 2 systems. And the regulator complaint path if the bank freezes or closes the account. Your move is 4 pieces of information from the bank and a complaint filed with the OCC if that is your regulator. 6 triggers, 6 action steps, all of them available to you right now. The bank does not waive a CTR because you are honest. The bank does not tell you when a SAR is filed. The system does not slow down because your withdrawal had a legitimate purpose. A BOI headline does not erase the bank's own ownership questions, and a closed account does not fix itself because you left 1 more voicemail. Having the right to use your own money and moving that money in a way that does not trigger preventable trouble are 2 different things. The gap between them is information. I want you to think of 1 person right now. A parent, a widowed neighbor, a church friend, the older couple on your street paying contractors in cash because that is how they have always done it. Share this with them, not because they are doing anything wrong, because they may be 1 unusual transaction away from a report, a review, or an account restriction they never saw coming. And the difference between getting caught off guard and being ready is whether somebody sat them down and walked them through the rules before the bank did. Subscribe, share this with 1 person over 60 who still handles money the old-fashioned way, and I'll see you in the next one.